This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. Imagine you've owned shares in a great company for several years. You still believe in the business, you don't want to sell your shares, but you're worried the market could fall over the next few months. Rather than selling your investment, some investors choose to buy a protective put. Think of it like insurance for your portfolio. You hope you'll never need it, but if the market falls sharply, it can help limit your losses. In this video, we'll explain how protective puts work when investors use them and walk through a simple example. A protective put simply means buying a put option on shares you already own. Remember, a put option gives you the right, but not the obligation, to sell your shares at a predetermined price before the option expires. If your shares fall significantly, the put option increases in value. That increase can help offset some of the losses in your shares. Just like house insurance, you're paying a premium to protect something valuable. Before planning to use protective puts, there are 3 important things to check. First, does the company actually have listed options? Not every stock has an options market. Options are generally available on larger, more actively traded companies. Second, does your broker offer options trading? Some investment platforms allow you to buy shares, but don't provide access to options. For example, you may own shares through one platform, but need a different broker if you want to trade options. Finally, many brokers require you to apply for options approval before you can place your first options trade. It's much better to check these things before building an investment strategy around protective puts. Let's look at a simple example. You own 100 shares of company ABC. The shares are trading at $50 each. Your investment is worth $5,000. You decide to buy one put option with a strike price of $45. The premium costs $2 per share. Since one option contract usually covers 100 shares, you pay $200 for the protection. Now let's see what happens. If the shares rise to $60, your shares increase in value. The put expires worthless. Your only cost was the $200 premium. If the shares stay around $50, the put again expires worthless. You still own your shares. The premium was simply the cost of the insurance. But imagine disappointing company results cause the shares to fall to $35. Without protection, your shares would have lost $15 per share. With the protective put, you still have the right to sell your shares for $45 before the option expires. The put has helped protect your portfolio from a much larger loss. Investors don't usually buy protective puts all the time. Instead, they're often used when uncertainty is higher than normal. For example, before company earnings announcements, before important economic news, during periods of increased market volatility, or when an investor has made significant gains and wants to protect part of those profits. The goal isn't to make money from the put. The goal is to reduce risk while continuing to own quality businesses. Protective puts have several advantages. They limit your downside, you continue owning your shares, and you still benefit if the share price rises. The main disadvantage is the cost. If nothing bad happens, the option expires worthless. Just like house insurance, you hope you never need it, but many investors are happy to pay a relatively small premium for the peace of mind it provides. Protective puts are one of the simplest risk management tools available to investors. They won't increase your returns, but they can help protect the wealth you've already built. Remember, protective puts are only available on shares that have listed options, and you'll also need a broker that supports options trading. Like any form of insurance, the protection comes at a cost. Whether that cost is worthwhile depends on your goals, your outlook, and your tolerance for risk. If you found this video helpful, please consider subscribing. On this channel, we simplify investing and help you build wealth while reducing unnecessary risk. Thanks for watching, and I'll see you in the next video.